Hey, this is Warren Redlick. So many people are excited about the Aptera. This vehicle is supposedly going to be this great vehicle that's everyone's going to love. And I think it's going to fail. I'm going to explain to you why. I'm going to dive in. Lots of people excited. I think they're all wrong. I'm going to go out on a limb here and say Aptera is going to fail. I don't think this is a big thing, but I'm going to dive in and show you all the reasons why. Are you ready? Let's go. Let's just start off with talking about what Aptera offers. They've got a 250-mile range version that's $25,900. The 400-mile range version is the launch edition. That one is about $30,000. You can reserve it for $100 today. It ends up being $33,200 when you add everything up. I'm not sure what else was it to be added up. That's the launch edition, so there's some other things that are included. You can buy a 600-mile range version for $34,600 and a 1,000-mile range for $44,900. Whether these ranges are accurate or not, of course, is an open question. I can't say for sure that these ranges are accurate, but this is, they're not even in production, not even close to production. But let's assume these numbers are accurate, which is a stretch. So the one positive thing I'll say about Aptera right now is they just got a grant. This is in March. This is like 2 weeks ago. They were awarded a $21 million grant for solar mobility manufacturing. This to me says that the California Energy Commission is not very discriminating, not very thoughtful, and this is why governments shouldn't be involved in business. Is the government giving money to this? This is going to fail. I'm saying this right now. This business is going to fail. Did the California Energy Commission take a look at the likely business prospects of Aptera Motors before giving them $21 million for manufacturing? But this $21 million will help Aptera continue to to carry itself along. I don't want to go so far as I call Lucid Motors a fraud. I'm not going to call Aptera a fraud. I don't know the people behind Aptera. I haven't seen them speak. I formed my opinion about Lucid Motors based in part on how Peter Rawlinson presented and how Lucid Motors presented back in September of 2020. I haven't seen anything about Aptera to suggest that I think they're deliberately fraudulent. I've just seen enough to say this business doesn't have much of a chance of succeeding. So just for starters, here's one of the things that stood out to me when I looked over Aptera. If you look at their website, they have a menu. And the first two items on the menu are investment options. There's home, but then there's invest and accelerate. Accelerate is a way of accelerating how quickly you get your Aptera by investing in the company. Then reserve a vehicle is the third choice, and the details about the vehicle the fourth choice. This company survives by getting people to continue investing in the company. They don't survive by generating revenue. They survive by persuading what I would say people who aren't very sophisticated investors to invest money in this business that has nearly zero chance of success for a variety of reasons. But if you were pushing your company, you would think you would push the product first, you would push the business model first. Instead, they're pushing the investing because that's how they survive. Right here, they've got this what I felt was a misleading bit here. Each vehicle can generate enough solar power for 40 plus miles a day of free daily driving. And with the battery topped off from solar charging, you can travel up to 1,000 miles on a single charge. And there we get here. The average American drives less than 30 miles per day. So most Aptera owners will never have to plug their vehicle into charge. No. Okay, so the average American drives less than 30 miles a day. That's probably roughly true. But the average American also goes on trips that are longer than 30 miles. Like it's an average of 30 miles a day. I don't know whether they mean the average American drives an average of 30 miles a day or the average American never drives more than 30 miles. I think we can all agree that people sometimes drive more than 30 miles in a day. Pretty common actually that, once a week, once a month, somebody's going to go on more than a 30-mile trip. And if somebody goes on a particularly long trip, if they get the 250-mile range version of the vehicle, it's likely that they're going to have to charge somewhere on the way. If you go on a 1,000-mile trip, even if you get the 1,000-mile range vehicle, you're going to need to charge on the way. And, will the solar power really generate 40 miles of driving? That's an open question. That would be at least 4 kilowatt hours. If they claim they're doing 10 miles a kilowatt hour, which is another stretch, and we can dive into that, and maybe we'll get into that at some point. But even if they were able to generate 10 miles a kilowatt hour, you would need to generate 4 kilowatt hours from your batteries, from your solar panels on the vehicle. And I think it's unlikely that they're going to generate that much because of clouds, because of the angle of the solar cells. There's a variety of reasons, and because of the amount of solar cells you're going to be able to fit on the car. it's probably going to generate enough electricity to run the air conditioning, right? Once you're running the air conditioning or the heating, you're not going to have much left to drive the car. It's a nice, idea, really, really unclear how much electricity this will actually generate on a daily basis. But this bit right here, this is a misrepresentation. Most Aptera owners will never have to plug their vehicle into charge. Is quite a stretch. They have the reservations number here. More than 40,000 people have already reserved an Aptera, representing $1.4 billion in value. That is a $35,000 average for their vehicles. If we go back to the ranges, a $35,000 average, the launch edition is $33,200. So it seems like a lot of reservations are at the 600-mile level or the 1,000-mile, and not many are at the 1,000-mile level. It's hard to tell. It seems like a lot of the reservations are in the middle. Just to cover that point. So next we're going to dive into their circular. This is Aptera's. When you go to invest, this is the document you can download, and you can see that the circular is dated December 9, 2022. It's not updated for end of 2022 numbers, right? We're now in March of 2023, and they haven't updated to show what their financial status is. This is something that I would say is troubling. If I'm an investor and you're going to try to sell me on an investment, I want current numbers. There's no reason that by late March of 2023, you can't provide your investors with what happened through the year 2022. So that's a troubling little detail. But this is just to give you an idea, what they're trying to do. They're trying to raise at $10 a share. They're trying to raise a total maximum of $41 million. So that's 4.1 million shares. That's roughly what they're doing. The company would get about $39 million out of that. It's pretty efficient. If they're able to do the cap raise like this and only pay that small percentage to the broker dealer and commissions and all that, that's a pretty good result, as far as that goes. The common shares outstanding as of August 25th, there's a whole list of stuff. And then the common shares to be outstanding after the offering. And there's an additional 4 million shares of Class B common stock, the second line that's there. Share price of $10 a share, minimum investment amount of $1,000. Just to go through what they're offering. If we sell all 3.9 million securities being offered, our net proceeds will be X, $38 million. Emerging growth company may take advantage of certain reduced reporting requirements as relieved of certain other significant requirements. So they're reporting less detail about their company than other companies you might invest in. I just find that now, I understand from an accounting perspective, it's less cost, but it doesn't cost that much. Now, this is probably the biggest deal of all. There's a whole lot of deals, but our auditor has issued a going concern opinion. Our company lacks significant working capital and has only recently commenced operations. We will incur significant additional costs before significant revenue is achieved. These matters raise substantial doubt about the company's ability to continue as a going concern, and our existing cash resources are not sufficient to meet our anticipated needs over the next 12 months from the date hereof. They intend to operate with funds received from Regulation A offering and future proposed campaign, additional debt equity financing. There's no assurances that management will be able to raise capital on terms acceptable to the company. We are unable to obtain sufficient amounts of capital, may be required to reduce the scope of our development, which could harm our business. This is a company that could fail if they don't raise more money. And we are in an environment right now where we've got potential bank runs. We've got the Fed might be raising rates. If you watch the All-In Pod, they talk about how when rates go higher, people are less likely to invest in startups. It's a real challenge for them to raise the money they need to go forward. And even that's not even getting into whether they can actually succeed in their business plan, which is a whole nother problem that I think is a huge problem. But you can just see they're telling you that their auditor has said this company may not survive. That's a pretty risky investment. There's always this question, what's the profit story, which I didn't find anywhere in this document. There's some other disclosures here. We face significant technological and legal barriers to entry. They said we do not, I think this must be as of December, or maybe this was as of August, or not sure what the date was. We do not yet have any prototypes and do not have a final design of manufacturing facility or manufacturing processes. Now, this has been pitched. I've seen, there's supposedly a prototype out there. At the time of the document, there's no prototype. Now, they're supposedly now, a few months after this document saying that they've got pre-production prototypes ready to go. that, the way it usually goes is you have a prototype and then you say, okay, how did we do on this one? Okay, let's re-engineer. And you do some iterative engineering and get to the point where you think you're close. And then you say, okay, how are we going to manufacture this thing? And then you come up with a pre-production prototype. And they're telling you right now, here in this document, where they're seeking your investment, we do not yet have any prototypes, even though they're telling, I've seen claims that they have not just prototypes, but they're ready for production. How did you go from December of 2022 saying we do not yet have any prototypes, do not have a final design, manufacturing facility, or manufacturing processes, to we're going to be manufacturing soon? Because that's the story I've heard. Maybe I'm hearing the story wrong, but this does not fit what we've been told. There's just this reference here. It's a small management team. They're dependent on the management team. Success of the company depends on the executives, especially Chris Anthony and Steve Fambro. There's no employment agreement with any of the aforementioned executives. Is that normal that there's no employment agreement with the executives? I'm not sure that that's normal. There's no guarantee that the executives will agree to terms and execute employment agreements that are favorable to the company. Should any of them discontinue working for the company, there's no assurance the company will continue. Now, I think they own a lot of shares. I think we'll come to that later. They own a lot of stock in the company, so it's going to be hard for them to walk away. But there's a concern right there that they're not, and even if they had a contract, they could walk away. So, and then just another detail, our officers control the company. We currently have no independent directors. Now, at this early stage, I don't think it's shocking they don't have independent directors. Executive officers and directors are currently also our controlling shareholders, holders of 55% of the outstanding Class A common stock. By the way, the stock that you'd be buying if you buy into this company is non-voting stock. As I understand it, it's non-voting stock. And it says right here, our executive officers and directors may be subject to potential conflicts of interest. I think there's some indication somewhere in the documents that there have been some transactions where there was a transaction with a business that was owned by an officer or director of the company. There's preferred stock with rights superior to those of the common stock in this offering, including a liquidation preference. So if the company goes poorly and there's some assets left over, not that this matters a whole lot, but if there's some assets left to be distributed, you're not getting them. The preferred shareholders are getting them. Bondholders are getting them first. I suspect that Class A and Class B shareholders are treated the same when it comes to liquidation. But if it goes to zero, or let's say it goes from whatever value it is, it drops down to 1/10 of the value. You're probably not even getting your 1/10. You're probably getting nothing. So you have to ask yourself the question when you're doing an investment like this: what's the upside and what's the downside? Well, the downside is zero, and there's a significant risk of zero. Now, do they sell anybody anywhere and what the upside is investing in this company? I haven't really seen a strong case for the upside. That's one of the problems. So this is the risk of immediate dilution. So you're buying when you buy shares in the company, you're buying a percentage of ownership in the company, but there's all these things that are going on. Company typically sells its shares to its founders and early employees at very low cash cost because they're in effect putting their sweat equity into the company. When the company seeks cash investments from outside investors, the new investors typically a much larger sum for the shares. So you're paying more for your shares than they paid for their shares. By the way, you're paying $10 a share. They paid a penny a share. But this demonstrates the price that new investors are paying for their shares with the effective cash price paid by the existing shareholders. The method gives investors a better picture of what they will pay for their investment compared to the company's insiders. And you can see the price per share, $10.50 a share. I'm not claiming I understand this part. I'm not claiming I understand the table, but you're being diluted. The people who bought early paid a penny a share. You paid $1. You're paying $10 a share. Yeah, you can see it right here. Since inception and prior to the commencement of this offering, the officers, directors, and affiliated persons of the company have paid an aggregate average price of 0.01 per share, 1 penny a share of common stock, comparison to the offering price of $10.50 a share. You're paying 1,000 times as much for your shares in the company as to what the founders paid. That's a pretty big gap. That's, I thought when I saw Gary Black's offering, I thought it was tilted. When I saw Boxable's offering, I thought it was tilted. Boxable's offering, you paid 33% of the capital into the company and you got 2% of the company. This is starkly worse. This is a really, really bad deal. You're not getting much for your money compared to what the founders got. This is use of proceeds. I thought this was pretty reasonable. This is how they're going to use your money. Proceeds to the issuer, development design. They're going to spend on development design, production equipment, selling in general. They're going to use the money for the business. So that part's perfectly reasonable. Okay, so this gets into the business of the company. So let me just dive into this a little bit. We aim to modernize vehicle design and manufacturing. Steel stamping makes the manufacturing process inefficient and significantly more expensive. With additive manufacturing, that's like 3D printing, the company can scale production and launch new models quicker. Now, I don't agree with this. I think, the evidence so far is that 3D printing does not scale well for large scale manufacturing. There's a reason why car companies and, SpaceX is using steel for Starship. This idea that you can 3D print things, there may be some cost advantages to it, there may not be, but I think when you're producing at large scale, it's not an advantage, it's actually a disadvantage. So with generative part design, we use artificial intelligence. It's like you're just squeezing in buzzwords now. We use artificial intelligence to optimize parts for the greatest strength with the least amount of material and weight. Artificial intelligence? How are you working artificial intelligence into this? That's a little bit given the amount of money that they have and the amount of money that they're spending, you're spending money on artificial intelligence. That's a whole big challenge of how you're going to apply artificial intelligence to this problem. Frankly, I don't even believe that that's true. I mean, I'm not saying, I can't say it's false. I'm just saying I don't find that credible. And our resin-infused sandwich core construction produces lightweight composite structures many times stronger than typical steel-based vehicle designs. This sounds like something that the early versions of the vehicle are going to be very expensive to build, and it's going to take them time to get their process to the point where they can manufacture at scale. That's just based on my general sense of how things work. We believe that through our different processes, we can lower manufacturing costs. This allows us to use inexpensive and simple tooling, fewer robots, fewer people, no welding. No welding, yeah, that makes sense. Rapid and inexpensive scaling. The additive manufacturing strategy gives us the advantage of 3D printed tooling versus milled and finished metal tools. I don't know that that's a rapid and inexpensive scaling. I don't know why they're saying that. Reduced part weights and counts allows for humans to easily position parts, making things easy and cheap to assemble. Less labor and less space. Our modularized build and human positionable parts require less labor and less space. So this is all claims about their manufacturing process. Here's the thing. The vehicle still weighs a fair bit, considering it only carries 2 passengers. If it's so much less weight, if it's so much more efficient, then why are you charging $30,000 for a 2-passenger vehicle? Basically, you're getting to the point where this vehicle costs almost as much as a Model 3, as a standard range Model 3. This vehicle is pretty expensive for something that's so inexpensive to manufacture. In addition, we'll be using efficient powertrains where the motors are integrated inside our wheels. I believe that that's a future step. I believe I may have this wrong. So they're planning to use motors integrated inside their wheels. That's hub motors designed to be aerodynamic and lightweight. These in-wheel motors are easier to install and service. I haven't seen an example in the real world of hub motors leading to high production, efficient production or efficient operation. I'm not saying it is, or I'm not saying it isn't. Solar power will be an integral part of our platform. Aptera's strategy leverages lessons from Tesla, direct-to-consumer sales, online production, test run. So they're sort of copying some of Tesla's model. I like personally, I don't buy the business model. They're working now. Here's another deal. They're working on developing relationships with suppliers that aim to produce vehicles. 2 separate agreements with Chery New Energy Automobile. I believe Chery is a Chinese company. I'm not 100% sure, but I believe Chery is the Chinese company. Chery will assist the company with feasibility studies and technical services related to certain components we use in our vehicles. The company will pay Chery fixed hourly rates for Chery's personnel and a license agreement pursuant to which the company is licensing certain technology from Chery to be used in production of the company's vehicles. Pay a fixed fee of $2 million to license the technology. And then there's a second license agreement with ELAF Propulsion Technologies, which is when they're going to buy motors from this other company. So they're not making their own motors. They're getting some sort of technology and some sort of consulting from Chery. And there's other agreements that they've made with others. Okay. An engineering service supplier, line production and production parts supplier, Red Viking, an automated guided vehicles supplier. Those are potential agreements. And here's where we really come to like the larger problem about how this company succeeds at scale. They say that we believe our current addressable market is the Roadster market, which we estimate at 600,000 units per year. We currently have over 38,000 pre-orders for our vehicles. Now, look, $100 pre-order. I mean, you could say this with Cybertruck too. $100 pre-order. Somebody can walk away from that really easily. Lots of people are walking away from their Lucid Motors orders, which are much bigger. The total potential Roadster market is 600,000 units a year, with sales ramping up to a rate of 10,000 units per year in 2022. It's the end of March in 2022, and they haven't produced one vehicle, and they're saying they're going to ramp to 10,000 units a year in 2022. I'm going to say they're not going to produce 10,000 units this year. I don't see how that's even remotely possible. They just got a grant for manufacturing to deploy manufacturing. There's no chance that they're going to produce 10,000 units in 2022. This is an opinion. I don't see how that's remotely possible. So they're saying they're going to replace motorcyclists and three-wheelers. Environmental advocates are going to buy their cars. Energy saving advocates are going to buy their car. Two-passenger car drivers are going to buy their car. Efficient commuters are going to drive their car. And that somehow that adds up to a total addressable market of 600,000 units a year. Now, a lot of people who buy motorcycles and three-wheelers want to buy motorcycles and three-wheelers. Environmental advocates can buy Teslas. Energy saving advocates can buy Teslas and other EVs. Two-passenger car drivers, they can buy four-passenger cars and ride two passengers in them. It just, this just doesn't fly with me. Efficient commuters, this just looks like somebody like threw something together on the fly and came up with these numbers to say we can potentially sell 600,000 units a year, or the market is 600,000 a year, and if we get 10% of the market, they get 10% of this market, maybe. Like, what's their market share potential? Let's say they got 10% of the 600,000 units a year. That'd be 60,000 units a year. Is that enough to make this company profitable? Is that enough that they can take all the money that they've invested and sell the vehicles and make a gross margin on these vehicles? You have to scale to a certain level of production in order to make a profit on, in order for the cost of producing the vehicles to be less than the price you're getting for selling them. What do they anticipate their market share is going to be? These are challenges. Now they have 69 employees. I think this is as of December, whatever it was, 2022. 69 full-time employees, had to be 69, and 12 part-time employees. No pension, annuity, profit sharing, or similar employee benefit plans. We may choose to adopt such plan. You've got 69 full-time employees. You don't have any pension, annuity, profit sharing, or similar employee benefit plans. We plan to engage contractors from time to time as an ad-needed basis. Okay. So they got to pay 69 full-time employees and 12 part-time employees. So that's a big chunk of expenses they've got. So there's this deal where they had a lease. They had a sublease of space. It was 14 months beginning February 1, 2021. As of December 31, 2021, they had not yet made any payments on the sublease. So they'd accrued the payments due within accounts payable and accrued liabilities. They're telling you, we're not paying the stuff. We're not paying people money we owe them. There's somebody we made an agreement with to pay them money, and we haven't paid them yet. Now, it doesn't say who that is. Maybe that's one of the conflicts of interest. Maybe that's a related party, but it doesn't explain that. Now, they've got another lease agreement, October 21, that's due to commence in May of 2022 for a term of 62 months. The company received approximately, whatever. They paid $2.5 million as a security deposit on the lease of the property. So you didn't pay for your last sublease, but you've already put down $2.5 million as security on the lease of the next property. And they've entered a new lease agreement for land and building that will commence in July of 2022 for 84 months, and they paid $926,000 as a security deposit on lease of that property. So they're arranging space, but that's the lease is due to commence in May of 2022 and July of 2022. So they've got to fit out their fact. So this gets back to this idea they're going to sell 10,000 units, or they're going to produce 10,000 units in 2022. They're not even going to have their factory space until May or July of 2022. Then they've got to put equipment in it. So there's no chance that they're not going to produce any vehicles in 2023. Was that thing? That say 20? This said their sales would ramp to 10,000 units in 2022. They're not going to do any units in 2023. This is crazy. Operating expenses. The company invests significantly in engineering. Company recorded total operating expenses of $32.8 million for the 6-month period ended June 30, 2022, and $4 million for ended 2021. So they're spending a lot of money. It was an $18 million increase in R&D costs related to engineering services, $10.7 million increase in general selling and administrative expenses. They're spending a lot of money. They spent $32 million in the first 6 months of 2022. We don't know what they spent in the last 6 months of 2022. It's just a breakdown here of what their expenses are. I don't think I'm going to bother going through this. There's a whole bunch of details here, but they're spending a lot of money. They're spending a lot of money. They're spending a lot of money. More about the money that they're spending. Liquidity and capital resources. As of June 30, 2022, they had $36 million in assets, including $19 million in cash and cash equivalents. Now, what did we say? They'd spent $38 million in the first half of the year. They got $19 million in cash left. Right now, they got their $21 million from the $21 million grant. That has to go into things that they hadn't paid for yet. That's like manufacturing equipment. They still got their R&D expenses. They've still got their general and selling and administrative expenses. So they're going to burn through, or they should have burned through, their $19 million in cash halfway through the second half of the year. So, it would be helpful to know how much cash do you guys have on hand right now. We don't know the answer to that. So they do say our history of recurring operating losses and negative cash flows from operating activities give rise to substantial doubt regarding our ability to continue as a going concern. We believe the proceeds from the offering, together with cash and cash equivalents, will be adequate to meet liquidity and capital expenditure needs requirements for ongoing operations. So there's a whole bunch of issues here. They did another funding round with B1A preferred stock. This is preferred stock that's superior to yours if the company fails. They raised $700,000 for that. They don't say how much cash on hand they had at that point. October, they did a non-binding term sheet with a potential investor. Investor agrees to purchase 2 million shares of a yet-to-be-formed class of preferred stock of the company for $10.50 a share, with total consideration of $21 million. That, as far as we know, that hasn't gone through yet. The financing does occur. The earliest will be Q2 of 2023, so it hasn't gone through yet. So that preferred stock offering hasn't gone through yet. So basically, you're paying $10.50 a share for common stock. This investor is going to get preferred stock, which is superior to your stock in terms of when the company fails, they get their money before you do. So they're paying the same price as you, but they get a better deal than you do. And they get the opportunity to appoint a director if it goes through. Contingent on the completion of financial legal due diligence and both parties agreeing on final terms. And upon the achievement of certain milestones by the company, the shares of preferred stock will be converted on a one-on-one basis to the company's Class A common stock. So it converts the common to voting stock instead of your stock. So this is a much better deal. They get the upside. If the company succeeds, they get the upside. They get the full upside, plus they get voting rights. On the downside, they get paid before you do. And they're paying the same price as you are. So some other details. This is just a little bit about the executives of the company. So Chris Anthony is there are two co-chief executive officers. I hate seeing co-chief executive officers in a startup. One's 46, one's 54. Founder and CEO of Flux Power, an advanced lithium battery tech company. Founder and CEO of Epic Boats. One of the things that's not mentioned here, I don't see this anywhere in the document, is, as I understand it, Aptera failed once before. And I don't know what these guys' relationship is to Aptera from before. Did they just get the idea? How did that happen? But Sarah Hardworth's the chief marketing officer. Now, compensation. The CEO, directors, Chris Anthony gets $211,000 for the fiscal year ended December 31, 2021. Steve Fambro got $180,000. The CFO got $181,000. So there's a lot of money being paid to people who haven't succeeded yet, right? They own a lot of stock in the company, so they benefit if the company goes up in value. But they also receive medical and health benefits, generally available to all, so that the employees get medical and health benefits. Mr. Anthony, Mr. Fambro got 540,000 shares, options for 540,000 shares under the stock option and incentive plan. So there's no employment agreement, but they've got a stock option and incentive plan. 1/4 of these options will vest on July 28, 2022, and the remaining options will vest annually over the following 3 years. So they've got a pile of stock coming to them. The first one doesn't say what the price per share is. This one says exercise price of $3.80 per share, granted to Ms. Burlingame. That's the CFO. Burlingame notified of her resignation as CFO of the company. Was not the result of any dispute. She is transitioning to an advisor role for the company, also acted as principal accounting officer. So she got the options and then she resigned. That doesn't sound great. So Michael Johnson Properties. So Chris Anthony and Steve Fambro each own 27% of the company. There's this company called Michael Johnson Properties Limited, which owns 27.38% of the company. So Michael Johnson Properties owns a big chunk of the company. They own 27% of the company. Chris Anthony and Steve Fambro own 27% each. The Patrick Quitter Trust owns 10%. All executives, officers, and directors as a group own 54%. So I think that's the two of them own 54%, and these are not officers and directors. So who's Michael Johnson Properties Limited? Who's the Patrick Quitter Trust? I don't know. Then you look at their current assets. Now this is as of June 30th of 2022. They had $19 million in cash, which didn't change from December 31, 2021. They're claiming total assets of $36 million and liabilities of 113. The total liabilities are 113 million. So they've got $36 million in assets and $113 million in liabilities. Simple agreements for future equity. This is the big one. This is something I'm not going to claim I fully understand. Simple agreements for future equity. I think these are agreements where how you're going to be diluted, how they're going to have to give other people stock in the company, and that's valued at $102 million. That's the big liability. Statement of operations, they had $231,000 in revenue, gross profit on that of 195,000. I forget what they were selling exactly. But the operating expenses were $32 million, so they had an operating loss of $32.5 million because they're spending all this money on general, selling, and administrative expense and research and development expense. We're looking at this column here, 6 months ended June 30, 2022. Then the safe liability increased, I guess, by $20 million. So their loss before income taxes was $53 million. I don't think they paid any income tax. So a net loss of $53 million on a company that, you know, it's just not good. Cash flows, 52 net loss is $52 million. Net cash used in operating activities was $21 million. Net cash used in investing activities, $3.2 million. Net cash provided by financing activities, 25 million. So they're floating on people continuing to give them money. People continue to invest money in a company that is, not doing well. Simple agreement for future equity. The company entered into safe agreements with various investors in exchange for cash proceeds totaling $53,000 and $2.5 million respectively. Safe agreements with certain independent contractors as compensations for services performed by them, the amount of $80,000 and $0 respectively. The agreements provide the investors certain rights to future equity in the company on terms of the safe agreements. They have no maturity date, bear no interest, materially consistent terms, must be settled primarily upon the following events: a qualified equity financing. So if there's an IPO or there's some kind of qualified equity financing is defined in the agreement, a liquidity event or any other liquidation dissolution. They become convertible into shares of a special class of the company's preferred stock. So they get preferred stock. So they also, if the company fails, they get paid before you do. This just, further stresses. If this company, fails, you get nothing. These guys get something, you get nothing. In the case of a liquidity event, they were paid at their option, either cash equal to their safe amount or the number of common shares equal to the safe amount divided by the price per share equal to the valuation cap. And what's the valuation cap? I don't know what this valuation cap is. So this is a complicated thing, which I don't fully understand. I don't claim to understand it. This is troubling to me, is that there's this complicated stuff out there. Like if I'm investing in a company, I want to know who owns what share of the company do I own, what share of the company am I going to own in the future. And this is so complicated, I don't really know what I own or what I'm going to own. I don't know what this liability is. This is just troubling. And then there's stock-based compensation out there. This is how much stock that the people running the company are getting. So this is the basic story. And the thing that I just want to come back to, like what I think is really the big deal, is I don't think many people are going to buy this. I think that it's a two-seat vehicle. You guys know, if you follow my channel, I have my own sort of like fantasy that I'm going to open my own startup that's going to make a single passenger vehicle. This is a two-passenger vehicle. I'm going for efficiency in a variety of ways. I'm not doing this 3D printing stuff, at least not now. A key difference between what I want to do and what they're doing is you see how wide the front of the vehicle is, because when you do a three-wheeled vehicle, you have to make the two-wheel section wide for stability purposes. The vision I have is for a four-wheeled vehicle, the batteries are going to be basically at the level of the center of the wheels. So it should be stable no matter how narrow it is, but probably be 4 feet wide. This is, I think, 5 or 6 feet wide. Their claims about the aerodynamics, the frontal surface of the area of this vehicle is fairly big. So maybe it's half the frontal surface area of a Model 3. It might even be more than half the frontal surface area of a Model 3. They're claiming an amazing coefficient of drag. I think the shape certainly gets you a good coefficient of drag, but there's so much complexity to this vehicle. They're claiming it's simple, but the practical reality is there's complexity to the vehicle. I don't know how many people are going to pay $35,000 for this car, right? And how many do they need to sell in order to be able to turn a profit? I don't see those numbers here, right? What did they say at the beginning? They said they have $1.4 billion in potential revenue. Okay, well, what are your costs going to be for making the vehicle? How much profit is that? What's the gross profit on that going to be? And how many people are going to follow through on the reservations? So it's $1 billion in revenue. How much money is being invested in the company? What's the return on investment? What's the return on investment? Can you manufacture, when you manufacture your first 40,000 vehicles, what we've seen with other companies that are other startups is when they manufacture their vehicles, their initial cost is high. So we're going to see a major cash burn for this company. Assuming they even get to the point of manufacturing vehicles, we're going to see a major cash burn. Yes, potentially in the long term, they'll be able to manufacture vehicles at low cost, but initially they probably won't be able to manufacture vehicles at low cost. And one of the things they're selling is they're claiming 10 miles a kilowatt hour, which is more than double the efficiency of a Model 3. Now, is it possible? Yeah. They got a low coefficient of drag. There's so many things that have to go right. Don't forget that Teslas are very, very efficient. There's a lot of efficiencies in a Tesla. Are they going to have all the efficiencies? Are they going to be as good at Tesla at being efficient in their first iteration? Probably not. It's a lot to ask of a company. At least Lucid Motors, I'm a big critic of Lucid Motors. At least Lucid Motors had a lot of money to throw at this problem, a lot of money to throw at the engineering problems. I don't see that Aptera has the resources to do all the things that they say they're going to do. And fundamentally, do I think it's a cool car? Yeah. Do I want them to succeed? Yeah. I think it's a great idea. I think it should, if it's only going to carry 2 passengers, it should probably cost less than $30,000 or $35,000. You should be able to sell this vehicle. Maybe if it was a $20,000 vehicle, maybe it would make sense. But at $35,000, okay, you're more efficient on electricity. But I paid so much money, I could have bought, a Model 3, which is still efficient, seats 4 or 5 people, reliability, supercharger network. There's so many advantages to that. I think Aptera may have said they're going to use the supercharger network, but their battery pack is so small that they're not really ideal for the supercharger network either, because they won't be able to charge at a high enough rate, because you can't typically charge at more than 3x your battery pack size. So if you have a 40 kilowatt hour pack, you can't charge at more than 120 kilowatts. If you have a 20 kilowatt hour pack, you can't charge at more than 60 kilowatts. So not for any meaningful length of time anyway. And even that wouldn't last long. So I just personally, I don't see this being viable. I want to caution people, if you're thinking about investing in this company, download the circular, read it for yourself, contact them and say, hey, how much cash did you have on hand at the end of 2022? Like, at least wait for the numbers for the end of 2022 before you invest in this company to see where they are. But ask yourself, like, what are the odds that they're going to be able to, because the next round of investing isn't going to be enough. They're going to have to raise more money from investing. They're not going to get to anywhere near positive cash flow until 2025 at the earliest. So they're going to be burning cash for, a year and a half, 2 years or longer just to stay alive. I just see this as a huge risk, and I'm going to say it. I think Aptera fails. I'm fairly confident that we will not see Aptera. Now, I wrongly predicted with Lucid Motors that they would never sell a car. They did sell a few cars. They certainly fallen way behind. I'm still convinced that Lucid Motors is going to fail. They did better than I thought in a sense, but huge problems. And by the way, check out Monroe Live has a breakdown, is looking at a Lucid Air. They've got 2 videos up already that I've seen. But I just fundamentally think too many hills to climb, not enough capital, too hard to raise money. The cash burn that's going to happen when they get to the point of actually manufacturing and trying to sell cars is going to be way too high. And I don't see how this company survives. I'm sorry. I want it to succeed. I think it's a cool looking car. I'd love to try driving one. I probably wouldn't buy one. But I'm actually curious whether the back cargo area is long enough that you could sleep in it. And how efficient is the air conditioning system going to be? How much energy is that going to burn? There's all kinds of issues there. But please let me know what you think in the comments below. Check out the t-shirts, Be Less Wrong t-shirt at elonbits.com, and all the other merch at elonbits.com, the stainless steel water bottles, the other t-shirts. Please support me on the Locals platform, on Patreon, or as a YouTube channel member. Please check out my other videos. Like this video, share, and subscribe. And thank you so much for watching.